Hello and welcome to this session in which we will discuss contract leases more than a lease, and within the contract lease we might have leasing and non-leasing components, how to handle those situations. Let's go back and review a lease. What is a lease? This is what we discussed in the prior session. It's a contract, and this contract is classified as a lease if it specifies a particular asset, a specific asset, and we talked about more rules about this, and this asset grants the lessee, the person that rented the asset, the right to control it and benefit from it. And this is what we discussed in the prior session. What is a lease? Now, when determining the nature of a contract at its inception, at the beginning, when we're looking at a contract, it's important to decide if the lease or the leases, for that matter, we might have more than one, contain other elements of a lease such as other services. So you might have a lease. That lease, that contract, which is a lease, could be leasing an asset. You could be leasing an asset, which is, it meets the definition of a lease because you need an asset. Then it has other services. Now, how do we handle those other services? Are we combine them together, the asset and the service, or are we account for them separately? How about if we have a contract and that contract will have kind of multiple contract inside of it, multiple leases. In other words, we have multiple assets, and each asset might give the lessee a different right to use the asset. Well, how do we handle that? So we might have multiple leases or multiple contracts. In addition to that, additional services. So how to handle those aspects of leasing, this is what we will discuss in this session. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, FarhatLectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
The best way to start is by looking at an example to illustrate the questions that I raised on the prior slide. So let's assume TechCorp enters into a contract with a service provider, Cloud Solution, for IT infrastructure and support services. The contract includes the following: a lease component. Cloud Solution provides stack with dedicated server hardware located in their data center. That's an asset. That's a separate asset. TechCorp has the right, the lessee, TechCorp is the lessee, has the right to control the use of the server hardware. They can decide on the operating system, the application to be installed, and the data to be stored, so they can benefit from it. So what do we have here? We have a leased asset that gives TechCorp what? The benefit, the right to use it. Therefore, we have a leased asset. In addition to that, TechCorp, or we also leased network equipment from Cloud Solution. So now we have another asset. We have two assets here. Now, in addition to that, we have non-lease components. What are they? Maintenance and support services. Regular maintenance of the server hardware and technical support for any issues that arise. This is provided by Cloud Solution. Also, software as a service, SaaS. And you need to know what SaaS is. Access to proprietary software application hosted by Cloud Solution, what TechCorp employee can use for data analysis and project management. Again, that's another service. So notice these are additional services in addition to the leased equipment, the hardware, and the network equipment. Also, security services. Cloud Solution provide continuous monitoring of the server as an additional service against cybersecurity threats, which we should be very familiar with cybersecurity threat as CPA candidate. Now, these three are what? Are non-lease component. In other words, they are services. So notice in this contract, we have two different assets and three different services. So what can you do? You can combine and treat as a lease, one lease, everything. You can combine everything as treat as one lease. We have one lease. We have conditions that would give us that, or you can treat them separate, which is separate, means capitalize the lease or the leases. If you determine we have two different leases here, one for the network equipment, one for the cloud solution, and the service agreement you expense. So simply put, we have an asset capitalized and we have an expense, which is the asset under the leases, and the service agreement and expense under revenue recognition rules. Now, at the inception of the lease, we have to determine the lessee need to evaluate whether multiple contracts should be treated as a single contract. What does that mean? Here we have kind of multiple contract. The hardware, the network equipment, as well as the leases. They have to determine whether that's the situation or not. Do we have one or multiple contracts? This involves examining the contract to see if they are interrelated in terms of their negotiation. Did we perform this negotiation altogether at the same time, the asset and the service, kind of one whole deal? Pricing. The pricing of the lease and the additional services. Are the pricing dependent upon each other? Whether we took the leases, do we have to pay extra for the services? Are we getting a discount? Are they connected in terms of pricing? And the intended purpose. Is this a comprehensive package to provide one solution for our issues, or is this for servicing more than one issues we are dealing with? Because that's what we have to do. So there's no straight answer because you have to examine the contract. You also have to identify lease component. With any contract or group of combined contract, the lessee must identify distinct leased component. Like in the prior example, we have equipment, network equipment, and we have hardware. A lease component is a part of the contract that grants the lessee the right to use an asset for a certain period of time. Network equipment, and what else? And the server. Also, we have to separate lease and non-lease component. If there are separate lease components identified, the lessee must decide whether these should be accounted for together or separately for any non-lease component. And notice in this, we have 3 non-lease components. We have to decide what we need to do with this at the inception of the lease. Non-lease component might include services and other elements that are part of the contract but do not constitute a lease component, such as maintenance services for the leased asset. Now, let's talk about rights, multiple rights. When we have a lease, we have to determine how many rights do we have. Identify rights of use asset. Do we have 1, B, C, 1, 2, and 3, or do we only have 1? The first step is to identify each specific right to use an underlying asset granted by the contract. And this is important because each right, each distinct right to the asset can potentially be considered a separate lease component. Again, back to the hardware and the networking equipment. They could be they're two separate assets, and they could potentially be considered 2 separate lease components. What are the basic rules? The basic rules are the following. If there's a single right to use asset, the right constitutes 1 lease component. If you have 1 single right, then you have 1 lease component. If the contract grants multiple rights to use the same or different asset, now we're dealing with different asset, it's necessary to evaluate whether each right should be treated as a separate lease component for accounting purposes. So let's assume the hardware is the main and the network. Do they come together? Can we separate them? Is the network giving us different rights? And we're going to see how do we separate them. Let's take a look at another example as well to kind of illustrate this concept again. Let's assume City Brew Cafe enters into a contract with property owner to use commercial space. This contract provides City Brew with multiple rights to use different assets within the space. Here's the details of the contract. The main lease component is the right to use the commercial space for operating a cafe. That's what City Brew does, operates a cafe. But it gave them additional rights. Well, use of a designated parking area for customers. 2. Use of storage unit located within the same property complex. 3. An option to use an adjacent outdoor area for seasonal cafe extension like a summer patio. Now the question is this. We have 1, 2, 3, 4 different assets here. The main asset is the commercial space. Then we can say the parking by itself is a separate lease component. The use of the storage unit located within the same property, and the outdoor for the seasonal cafe extension. And we can make the argument that all of this is 1 contract. This is 1 lease. Or we can say the following. Again, you got to use your imagination. And the reason why we do this is because you have to examine the contract. How about if City Brew, yes, they want to open a cafe in this commercial space, but they got this parking lot, parking space, and they can rent this parking space to a hospital nearby, so the hospital customers can use it. So simply put, the parking area becomes a totally separate lease component. Why? Because they're using it for separate purpose other than the cafe. Same thing with the use of storage unit located with the same property complex. You can argue that this storage unit is used to store material for the cafe. Or we can say we're going to let the hospital store some medical equipment or medical supplies in it. Same thing for the additional cafe extension. We could use it for some other purpose, for a third purpose, only for special events at that hospital. That's it. So for each of these rights, City Brew would need to evaluate if they meet the criteria to be considered a separate lease component. Now, again, I'm making assumptions to tell you we have to examine the contract. That's what we're saying here. So you have to determine. So step one is look at the contract. If there are multiple different assets, determine, what are the assets. Then step two, once the rights to use the assets have been identified, which is we identify them, the next step is to decide if these rights should be accounted for as a separate lease component. Well, two main criteria need to be satisfied for the right to use asset to be considered a separate lease component. If you want to consider an asset a separate lease component, here's what you have to do. The asset has to have a standalone utility. What does that mean? It has a standalone utility. It means the right to use the asset should provide benefit to the lessee. It's giving you something of a benefit, either on its own or in conjunction with other resources that the lessee already has easy access to. Let's go back to the parking space. As I mentioned, this parking space could be devoted totally for the cafe. It means without the cafe, this parking space is useless. Or, as I mentioned, this parking space can be enjoyed either on its own. How? You rent it to another business, to the hospital nearby, because they need extra space. You have this asset and you rented it separately. So this is what we mean by standalone utilities. You would look at the usage of it. This means the asset use should be valuable to the lessee independently of the other lease component. And the parking space can be used independently. Same thing with the storage room. The second condition is independence of rights. The right to use the different assets should not be highly dependent. So simply put, the parking lot is not highly dependent upon having the cafe. So basically, they're giving you the parking lot as I can use it for whatever reason I want to. My right to use it is whatever I want to. If they say, no, you cannot rent it, you can only use it for your own customers, then that's it. I lost this right. I can never now treat the parking space as an independent asset, in quote, independent asset for a lease. Same thing with the storage area. If they say you can only use it for your own supplies, I'm done. So for an asset, so for these assets to be treated separately, let's go back here. For these assets to be treated separately as separate asset, they have to have a standalone utility, and I believe they do, but independence of rights, that's depending on the contract. If the ability to benefit from one right is contingent upon having another right, or if the rights are so intertwined that they cannot be separated in practice as well, they may not qualify. So let's assume they are, the storage area, it's inside the cafe. Let's just use our imagination. So to access the storage area, it's inside the cafe. Well, really, no hospital. What if the hospital needs supplies 1 o'clock in the morning and the cafe is closed? You don't want any access to the cafe. Then it's not practical. So again, you have to look at the different component. So for each of these rights, City Brew would have to evaluate if they meet the criteria to be considered separate lease component. This involves assessing if each asset can be used interdependently or in conjunction with readily available resources. Think of the revenue recognition rules that we covered. Hopefully you remember, but this is what we're talking about here. If the rights to the assets are not highly interdependent or interrelated, so that's what you look at. Are they independent or interrelated? Yes or no? And this is how you make your determination. Now, when to combine multiple contracts. So if you have multiple contracts, when to combine them? Okay, well, here we go. Combining multiple into a single contract, like, let's assume we're going back to the hardware example and the networking example, if all the following conditions are met. Well, at least one of the contract under consideration must be a lease in itself or contain a leased component, it means an asset. So you have to have an asset. This means there's an identified asset that one party has the right to control and use for a period of time. Of course, we have to have an asset, a lease. Timing of the contract execution. The contract in question should have entered into around the same time. So when you enter into this contract, they're all together. You enter into the contract all together. The criterion helps in establishing a connection between the contracts, suggesting that it might be part of a broader arrangement deal. So if you enter into the deal with the parking spot, the commercial space, and the storage all together, it looks like you're getting this for your cafe. Also, common parties. The contract should involve the same parties, or the parties should be related in some way. This could mean that the contract are between the same two entities or entities that are part of the same group of companies. It means you have the same party doing all of this at the same time. 4, interconnection of the contract. And this is important. There should be a significant link between the contract manifested in one of the following ways. How do you show that there's interconnection? Well, you could show that the performance or pricing of one contract influence the payment or performance of the other contract. Well, this indicates that the contracts are economically interdependent. So what does that mean? It means the pricing of one versus the other, they are independent. So if you choose one and not the other, it makes a difference to the price. So they are interdependent. Or the contract shared the same commercial objectives and were negotiated as a package, suggesting that they are part of a single transaction rather than a separate deal. Going back to the cafe, well, you need a parking space for your customers, you need storage for your supplies, and I wasn't sure what was the third condition. Let's go back and see what the third condition was. The third condition was what? The third contract is an adjacent outdoor area. Yes, they are all, yes, and it's reasonable to see that they are all part of the same contract. What does that mean? It means now you can combine them. So they share the same commercial objective, and the right to use the underlying asset as stipulated in the contract don't qualify as a separate lease component according to the accounting standard. And also, if we go back to, if you want to use it separately, they don't meet this. This means that the asset is so intertwined that it's effectively form a single lease component. They're interrelated. You cannot separate them. The whole commercial objective will be gone from the contract. If all these conditions are met, the contract should be considered and accounted for as one combined contract. Now, how about if you have land involved? When it comes to accounting for lease component, we have a specific rule applies to the right use of land. The right is generally treated as a separate lease component. So land is a separate lease component. It means what? It means that the lease agreement where land is involved, the right to use the land should be accounted for independently from other element of the lease, because the land is separate than the other assets, the building, the equipment, the land is separate. There is an exception for this. If separating the right to use of the land from other lease component would have an insignificant impact on the financial statement, it means the land component is immaterial, then it may not be necessary to account for the land as a separate lease. This could be the case in scenarios where the value or the cost associated with the land, the right to use it, is minimal compared to the overall lease agreement, or where the separation would not materially affect the financial position. So it's immaterial. The land component is immaterial. Now let's take a look at leases and non-lease component. Remember, leases, we have asset, specified asset. Non-lease component are services. When dealing with a contract that has both lease, which is the right of the use of a piece of equipment, an asset, and non-lease component, services, what can we do? We can combine lease and non-lease component. We can combine them. In this approach, each separate lease component is bundled together with its related non-lease into a single unit of account. Simply put, it's a lease. We combine them and we treat them as a lease. This means that the cost and benefit associated with the lease and the non-lease component are accounted for as one combined item in the financial statement. In this approach, simplify accounting but reduce transparency, because now you're combining the lease with the service of the separate cost and benefit of the lease and non-lease component. Or you can separate them, separate unit of account for lease and non-lease component. The second option is to keep the lease component, which is the asset, and the non-lease component as a separate unit of account. This means the cost of and benefit related to the lease itself are accounted for independently from those associated with the non-lease component. Listen to me carefully. Here we're discussing the lease, the asset, versus the non-lease component, the service. What we were discussing earlier is different leases for assets. Okay, this approach provides a clearer picture of the financial implication of the lease and non-lease element of the contract offering greater detail and transparency versus option 1. Now, when we're looking at a payment for a lease, what's included in the payment? What's the contract consideration? When determining the total consideration for a contract, what do we include? Well, it's made up of the lease payment itself, other required payment, if there are any. Then you deduct any incentive owed provided to the lessee, and this is what's going to come up with because we need the payment. So what is the lease payment? Well, the lease payment would involve all payment that the lessee is required to make under the lease terms, which is what? It could be a fixed payment, it could be a variable lease payment, like based on some index or rate, any residual value guaranteed, any potentially price, the exercise price of the purchase option, if the lessee is reasonably certain to exercise it. Those are all part of the lease payment. Usually the lease payment will be given to you in an exercise, just so you know what the lease payment is. Other requirement payment in the contract, you might have other required additional payment as part of the contract, but they're not directly classified as a lease payment, but they are still mandatory under the contract. What are we looking at here? You might have to pay taxes, insurance, fees, maintenance cost, depending on the contract itself. That gets added to the payment. And we have some break here. The lessor might give you some incentive. This includes any incentive, rebates, or concession provided to the lessee that are not already accounted for or within the lease payments. You would reduce those, minus you will deduct those. For instance, a lessor might provide an upfront cash incentive for the lessee to enter into the lease or agree to assume some cost on behalf of the lessee. Those are negative. Let's go back to the lease and non-lease component. When a lessee decide how to account for a contract with both lease and non-lease component, the allocation of the contract total consideration to these components depend on the accounting approach chosen. Remember, once we determine the payment, how are we gonna split the payment? Well, if option 1 is selected, it means combining the lease and non-lease components. So now we have is lease asset. In this scenario where the lease and related non-lease are bundled into a single account, the total contract consideration is allocated to each combined unit based on the relative standalone prices. Now we're assuming we have more than one lease. Standalone prices are the prices at which the component could be sold separately by the supplier. So this is, we're looking at the asset, and we have more than one asset. We allocate it based on the fair value of the asset, standalone prices. If option 2 is selected, separating the lease and the non-lease component, when this option is selected, means you are keeping track of each one separately. When the lease component are kept as a separate unit of account from non-lease component, the total contract consideration is allocated to the separate lease and non-lease component. Now you have 1 and 2. And how do you allocate them? According to their relative standalone prices. Same thing as in 1. This approach treats each lease and non-lease component as if it were a distinct contract, providing clarity on the value attributed to each. So we're separating the asset from the service. Now, how do you figure out the standalone prices? It's great if you have them in both options. The preference is always to use observable standalone prices when available. It means there's a fair value, and specifically level 1, there's some assets that are very similar or almost the same that you have this information. What happens if you don't have this? If you don't have this information, if observable standalone prices are not available, the lessee might use estimated prices. And these prices must be based on reasonable and supported assumptions. And they have to disclose this, and may involve considering the prices of similar component sold separately or other valuation method. So they have to tell you how did they come up with this, because there's no fair market value prices for those. The best way to illustrate this is to take a look at an example. Let's assume a hospital enters into a lease for 2 pieces of advanced medical equipment, a CT scanner and an MRI machine. The lease is for the duration of 5 years for each piece of equipment. The hospital will make monthly payments, which also cover maintenance services for both pieces and equipment. There are no additional fees for maintenance outside of these payments. The required monthly lease payments and standalone prices is as follows. So, the monthly lease payment for the CT scanner is 9, for the MRI machine is 10. These are the standalone prices. For the CT scanner, $464, and for the standalone price of maintenance, $46,000. For the MRI machine, if you want to buy it separately, $580. Standalone price of the maintenance for the MRI is $69,600. Well, first let's make sure we compute our payment. Our payment is, in total, both of them, the 9 plus the 10 equal to $19,000. We multiply this by 60 months. It's a 5-year plan, we're looking at a total payment of $1,140,000. Now, how do we report this? Well, what can we do? We can combine the standalone prices of the asset and the service and consider it one lease. So we have basically two assets, though. We're going to assume we have two assets, two separate leases, or we can basically treat each one separate. Okay, let's take a look at the first scenario where the lease and non-lease component are treated separately. What are the standalone prices? The CT scanner, $464,000, the MRI, $580,000. Maintenance for the CT is $46,400. Maintenance for the MRI, $69,600. Together, $1,160,000. Then we're going to find the relative value for each component. Well, we're going to take the CT scanner divided by the total. The CT scanner is 40% of the deal. The MRI machine divided by the total that we computed here, it's 50% of the deal. And the same thing for the maintenance and for the CT and the MRI. Now we're going to take the percentages that we find, the relative fair market value multiplied by the cash payment. And we're going to allocate the CT scanner $486,000. This is the lease. And for the MRI, 50%, $570,000. And for the other ones, it's going to be service, $45,600, $68,400. So these are lease, these are basically expense, or the revenue recognition would apply to them. The CT scanner and the MRI machine, we have the leasing rules. Let's take a look at, this is, I explained the steps. Let's take a look now at lease and related non-lease component are combined. Basically what we're saying here, the CT scanner and maintenance are combined into one, and the MRI machine and the maintenance are combined into another. Again, we're going to combine them. 510, 400 if we combine them, 649, 600. We add them up, 1,160,000. What we do is we take each one relative to the total. Now the CT scanner and the maintenance represent 44% of the deal. The MRI machine and the maintenance 56. Now we have two separate assets. One's we're going to be two separate assets. It means leases. The CT scanner is 501,600. We're not separating the maintenance from it. And the MRI 638,400. We take the percentage times the cash payment, and this is how we figure out we're separating the two separate assets. In the scenario, the lease payment for the equipment and the maintenance are considered together as a single component. And each piece of equipment is a separate lease. We kind of bundle the service with them. This means we will calculate the standalone prices for the CT scanner and the MRI machine, including the respective maintenance costs. We don't account for that separately, then allocate the total consideration based on these combined value. Let's take a look at this multiple choice questions from farhatlectures.com. Which of the following criteria must be met for multiple contracts to be combined for accounting purposes? We have multiple contracts. Should we combine them or not? So which of the following criteria must be met? We could have more than one criteria to be met, but which one of these? The contract are negotiated with different parties at different times. Well, if they are negotiated with different parties at different time, we cannot call them, the same, combine the same contract. I would think so, right? Because it's at different time with different parties. Well, I would say A is out. One contract's performance affect the pricing of another. So simply put, if we take one and not the other, they influence each other. Well, it looks here, there's some kind of connection between the two assets, because if they are totally independent, then they may not be affecting each other. So there's something here, but let's look at C and D. But there's some connection here. The contract are for unrelated asset. If they're unrelated asset, there's no reason, because each asset will have a different use. They're unrelated. Therefore, we have different leases. Therefore, C is out. That's easy. Each contract can stand alone without any impact of the other. Kind of like C, because if each contract, it means each contract will have an asset, and those assets are standalone without any impact of the other. Part of the combining them is that they are interrelated. If they don't impact each other, they're not interrelated. Therefore, C and D kind of using the same logic. You can eliminate both, and A is easy to eliminate. What's left is B, and B is the correct answer. One contract performance affect the pricing of another. Yes, choice B is correct, because if the performance or pricing of one contract affect another, it indicates some type of economic interrelation that warrants combining the contract for accounting purposes. Now we need to have more than one condition, but this is one of the conditions. one of 4. But this is what you need to know. What should you do now? You want to go to Farhat Lectures, look at additional MCQs. That's going to help you understand this concept. Whether you're studying for your CPA exam, accounting courses, or some other accounting certification. Good luck, invest in yourself, and of course, stay safe.